Hi, this is Dave Mantell, certified financial planner and partner with Stabler Wealth Management. Welcome to our workshop, Managing Wealth in 2022. Today's workshop will cover an economic update, as well as a review of proactive tax planning strategies to consider. As a comprehensive financial planning firm, we always try to consider the impact of any recommendation that we make on not just one, but all the key aspects of your financial plan. Today's presentation will first focus on investment planning in the equity markets, and then we will share with you some proactive tax planning strategies. "2021 was a healthy and impressive year for the equity markets. As this chart shows, 2021, the equity markets made very healthy advances throughout the year. Since the sharp fall of the stock market in early 2020, post-pandemic stock markets have been primarily robust. Despite many potential worrisome events, the equity markets have shown resilience and prevailed, rewarding investors with notable gains. 2021 saw many new records broken. The S&P 500 had 70 record closes for the year, while the Dow totaled 45 record closes throughout 2021. Stock valuations climbed, and many analysts credited the ultra-low interest rates, as well as a healthy economic recovery for this surge in the markets. Now, 2022, on the other hand, is already off to a very eventful start. Volatility is very prevalent and looks to be here for a while inflation has been surging. The Fed has began increasing interest rates, with several more rate hikes expected throughout the year. And with Russia's invasion of Ukraine, global unrest has been amplified. While COVID is still a concern, it has taken a bit of a back burner to these other world events. As you look at the 40+ year chart of the Dow, you can easily see that stocks have increased over the long term, despite many market pullbacks and dips. The sharp decline of 2020 looks a lot less severe as you look at the long-term results. This is why having a solid investment strategy is a key part of a well-devised plan for your financial goals and time horizons. Staying disciplined, not getting emotional, and following your strategy during times of volatility can be crucial and of utmost importance. Equity market downturns are part of the investment experience. They are uncomfortable, but not uncommon. Since 1949, so over a 70+ year period, on average, the S&P has experienced a pullback of 5% about 3 times a year. A correction or downturn of 10% or more happens about once every year, and a bear market is about every 6 years. So far this year, we've already experienced a correction, with the S&P 500 at one point dropping 15%. Of course, in 2020, with the COVID downturn, we experienced a bear market. Now, this year, the stock market has come back strongly the last few weeks after this rough start, but of course, it's unclear whether we've seen a bottom. The comeback has presented a good opportunity to review your investments relative to your time horizon and your personal goals. Recently, statistics have shown that at the end of 2021, inflation was at a 40-year high. Higher inflation means the cost of goods and services are going up, and therefore it requires many investors to look for good returns to keep up. The cost of safety today is near zero. Most investors cannot live with the low returns of today's money markets and banks, which in early March of this year, 2022, were less than 0.1%, and even a 12-month CD was well below 1%. So by now, you've heard that interest rates are set to rise in 2022, something that's already begun. The federal funds rate as of January 2022 was close to 0% and set to rise, which is not good for bonds currently. As once again, interest rates are low, and as interest rates go up, that puts pressure on the bond market. Now, one positive of rising interest rate expectations is that while rising rates have caused bond funds to struggle so far this year, many bond funds are now starting to provide a much more attractive yield for investors. With the Fed expecting to make multiple interest rate hikes over the next couple of years, we do feel it's best for investors to review all their income producing investments, lock in mortgage rates, or consider refinancing to get a better rate if you haven't done so already. We have noticed that there's a really wide range of where mortgage rates are across different banks. So this is something we'd encourage you to discuss with us if you're considering. Maintain liquidity for all near-term needs, and reevaluate and confirm your cash flow needs. During your regular client reviews, we'll conduct a full review of your financial situation. And during this review, we can look at risk management, how well diversified your plan is, and revisit your time horizons to make sure all your holdings are still compatible with your goals. Our hearts really go out to those affected by the Ukraine-Russia crisis. As of now, nobody knows how long this will last or how bad it will get. From a financial standpoint, this does add to the uncertainty in the near future, and economic markets do not like uncertainty, of course. So many are asking, what are investors doing today? Typically, the most successful investors think and act for the long term. Short-term movements in equity markets are near impossible to predict, but you can prepare, fortunately. Remember, equities go up and down. They are long-term investment holdings and should always be viewed that way. What is of most importance is how they perform over the targeted time horizon rather than the short-term gyrations that we'll see every year. Now, to summarize, again, volatility is likely to be around for a while. During these volatile times, caution and vigilance are critical. And please remember that volatility is part of the investment experience. Market pullbacks and downturns are not uncommon, and having a long-term strategy, staying away from emotional investing decisions, can help you ride the pullback waves and stay on track towards your financial goals. If you have any questions or concerns, now is a good time to revisit your financial strategies with us, including your time horizon and risk tolerance. We remind you to always focus on your own personal goals and objectives. And as always, we are here for you. So please call us with any concerns or questions you may have. Now let's talk a bit about proactive tax planning. We feel it's important to remember that proactive tax planning should always be a key focus when reviewing your financial situation. We believe that a proactive approach to looking at your tax situation can lead to better results than a reactive one. Tax laws seem to always be changing. Recent legislation like the CARES Act and SECURES Act have made significant changes that could affect your 2022 taxes. One of our goals is to point out as many tax savings opportunities and strategies as possible for our clients. We will review some of these broad tax issues and some potential tax reduction ideas. Please remember that not all ideas may be appropriate for your personal situation. This is for informational purposes only, and we always recommend you always address any tax strategy with your tax professional. Now let's look at some helpful proactive tax planning strategies for 2022. So first, let's review some of the key 2022 tax information. The IRS has released 2022 tax brackets. There are still 7 federal income tax brackets which have slightly adjusted up from 2021. The Biden administration's Build Back Better plan was expected to increase many of the federal tax rates. So far, this tax proposal has not been passed and has been significantly pared down from the initial version. Despite this, it is important to remember that at the end of 2025, the federal tax rates are scheduled to sunset and will adjust back to where they were before the Tax Cuts and Jobs Act changes that were put into place when Trump was in office. This will be a meaningful increase in tax rates for many people. So we do have a temporary window with very favorable tax brackets. Long-term capital gains are still currently scheduled at favorable rates for 2022 as well, with most capital gains at 15% and the higher capital gains bracket at 20%. Retirement planning for those who can is always helpful. In fact, it's never too early in the year to start contributing to your retirement plan if you're still working. Here are the current 2022 retirement contribution plan limits. Of additional note, many employer 401ks, such as Boeing and Microsoft, allow for additional contributions into after-tax buckets that can then be converted to Roth. This can be a very powerful strategy. If you have any questions about your retirement plan, please give us a call. You might want to examine taking advantage of the annual exclusion gifts. For 2022, the maximum amount of gift tax exemption is $16,000 per person. For example, you can give up to this amount to a family member without having to pay a gift tax. Additionally, you and your spouse can each gift $16,000 to the same person, so $32,000 between the two of you. And again, that will not be subject to paying a gift tax or not be reportable neither. Some ideas for using this annual gift can include contributing to a working child or grandchild's IRA or Roth IRA, gifting to a 529 plan, which is a tax sheltered plan for college expenses. Here are some proactive tax planning strategies because, as we said earlier, we believe that taking a proactive approach is better than a reactive approach, especially regarding income tax strategies. Our objective is to minimize your taxes whenever possible. So this past February, the IRS and Department of Treasury released a 275-page document with proposed regulation changes and implementation details to the SECURE Act, which stands for the Setting Every Community Up for Retirement Enhancement Act. Bit of a tongue twister. That was originally enacted in December of 2019. This act was designed to increase access to retirement plans and encourage retirement savings for many Americans. One of our goals as your financial professional is to keep you aware of any updates to the fiduciary or tax law that we feel may affect your unique situation. The SECURE Act also has changed some very important retirement withdrawal tax rules. The SECURE Act, among many things, included a 10-year rule that replaced the stretch IRA rule for most investors. Under the old rule, most non-spousal beneficiaries were able to use a stretch IRA, which meant they could take distributions over their lifetime. Today, unless you are the surviving spouse of the original owner, a minor child, a disabled or chronically ill individual, or less than 10 years younger than the decedent, you are more likely required to take out all your inherited IRA money over a 10-year period. The 10-year rule, especially on everything not in a Roth IRA, requires us to take a more proactive approach to potentially minimize your tax bills. There are further proposals out there to again adjust the SECURE Act even beyond this. The latest proposal would require that in addition to withdrawing inherited IRA funds over 10 years, you also have to take out at least a required amount, a certain required minimum distribution, RMD, each year as well. So again, example, you'd still have to draw out the inherited IRA over 10 years since inheriting, but on top of that, you'd have to take out at least a certain amount each year as an RMD. This does not apply to inherited Roth accounts. It's just being considered for inherited traditional IRAs. The SECURE Act also changed the required minimum distribution age to 72. Previously, the RMD age was 70 and a half, and under the SECURE Act, distributions are required to begin by April 1st of the year after you reach 72. A critical area to review in tax planning for your retirement accounts is what we refer to as family tax bracket management. If you have retirement assets that are not in a Roth IRA, when and who takes distributions can make a huge financial difference from a tax standpoint. So simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you and yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your lower bracket, convert these accounts to Roth IRAs, and then leave them in an account that still must be taken out over 10 years after your death, but can grow tax-free for up to those 10 years. A key step that we like to start with to help your clients look at tax minimizing is to compare your marginal tax rates with those of your beneficiaries' marginal tax rates each year. This is something we try to think about for clients, especially those with large retirement accounts. Especially now with the Secure Act 10-year rule, for some people exploring a Roth IRA conversion could be very helpful. Some benefits from Roth IRA conversions include they could lower your overall taxable income long-term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs at age 72 or when inherited. And Roth IRAs allow tax-free withdrawals for beneficiaries. And so again, as noted on the prior page with the Secure Act, when your heirs inherit a Roth IRA, they still have to take it out over 10 years, but there's no consideration right now of an annual RMD on top of that. So it could grow for another 10 years once your heirs inherit it. Partial or full Roth IRA conversions are not for everyone. Whether you convert part of all of your traditional IRA to Roth IRA depends on your situation. So before doing so, it is best to prepare tax projections and calculate the appropriate amount to convert. Like with many financial decisions, there are several pros and cons to making this change. And so please call us or talk to your tax advisor to see if this may make sense for you. So for those of us who are close to the standard deduction level, a strategy to consider is bunching your charitable donations into a donor-advised fund. As this example shows, someone who is slightly over the standard deduction amount each year can bunch 3 years of charitable contributions into a donor-advised fund in year 1. This could bring that taxpayer in a much larger overall tax savings over this 3-year period, for example. Then, as the other side of the screen shows, from your donor advised fund, you can still give your favorite charity money each year. So again, what you're doing is you're bunching multiple years, getting a larger tax deduction in that 1 year in which you'd itemize. And then in the next couple of years, you would donate to charity from your donor advised fund and take the higher standard deduction, right? So you're going to be itemizing, bunching, taking the standard deviation standard deduction the next few years, and then you could bunch again. So again, with the current tax laws, that's a good strategy to do. Now is a good time to explore if it's helpful for your tax situation to deposit cash, appreciate securities, or other assets into a donor advised fund, and then distribute that money to charities over time. Also, any securities such as stocks, mutual funds that you donate into a donor advised fund, you do not pay capital gains tax on. So another advantage. So if you're interested in a strategy or want some more information, please give us a call. So qualified charitable distributions, QCDs, are still a strategy for retirement savers in 2022. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after the age of 70 and a half and not pay tax on this distribution. One idea that experts suggest, if you're charitably inclined, is to consider using part or all of your required minimum distribution, or RMD, if you're over the age of 72, for a qualified charitable distribution, or QCD. Like many other strategies we're discussing today, this is one you should see us about if you're interested in for evaluating with your own personal situation. So we covered a lot of material today. Remember, when working with us, you can expect regular communication, more frequent discussions, and you can expect that we are constantly reviewing economic, tax, estate, and investment issues for our clients. We hope you've been receiving our mailings, including the most recent tax report we sent out a couple months back, and the Secure Act email article that we sent out the other week. If you haven't, or if you'd like a copy sent to you or someone who you think might find this information valuable, please give us a call so we can make sure you're on the communications list. One of our goals is to continue to help others. Many of our clients were referred to us by existing clients, So please feel comfortable letting us know if the names of anyone you feel could benefit from our services or information. Again, one of our primary goals is to keep clients informed, and we appreciate you attending our session. Please call if you have any questions for us. Thank you for your time today. We appreciate the opportunity to assist you with your financial goals.